Good morning, viewers. Welcome to the second quarter of our Global Dashboard. I'm Vinette Gasson, COO at Catalyst Fund Managers, and this morning I'm joined by Zama Nkambindi, an investment analyst of our global listed property portfolios. Zama, we've had quite the start to 2025. There's been so much macro disruption if we talk about Trump and tariffs, geopolitical tensions, and then a lot of uncertainty regarding inflation and interest rates. So in your opinion, what's been driving all of this volatility and how has it actually been affecting the markets?
Yeah, it has been quite an eventful couple of months, starting with the announcement of US trade tariff changes in April, which injected quite a lot of volatility within the financial markets. We saw a bit of reprieve with the 90-day negotiation window. However, with increased direct conflict in the Middle East, that has resulted in additional geopolitical risks and questions around the impact that will have on oil prices and therefore the trajectory of inflation going forward for the remainder of the year. What we've seen in the second quarter is a US Federal Reserve that has really taken a wait-and-see approach in terms of monetary policy decisions, and therefore we have seen no cuts in the US. However, across the pond, we've seen the ECB as well as the Bank of England take a more accommodative approach with additional cuts in the second quarter. I think despite the volatility that we see within financial markets, the on-the-ground fundamentals do seem to still give us a sense of stability within listed real estate. And we saw that over the quarter, listed real estate did post positive returns.
Okay, that's very positive to hear. Zama, you and some of your team members in our global team had the privilege of, traveling abroad and attending conferences. One was in Amsterdam, the other one in beautiful New York. What were some of the key takeaways from these conferences, and what was the general view from market participants about this current environment that we all have to navigate?
So yes, we did get the opportunity to go to the Van Lanschot Kempen European Real Estate Conference, as well as the NAREIT REIT Week in New York. And I think the general tone coming out of both conferences was one of caution with a modest sense of relief over the outlook of some of the macroeconomic concerns that have come about in the second quarter. I think that generally, real estate is looking at an environment where fundamentals have come out as the main focus, with a lot of management teams reiterating on-the-ground operations as well as full-year guidance within the meetings that we attended. And generally, we have seen a bit more transactions within certain sub-sectors as well as markets that give us a sense of some positivity, I guess, as it relates to some of the macroeconomic uncertainties that the management teams are really navigating during this period.
Zama, like you alluded to, there's so much noise that one should try to look through. So let's look past the noise and focus on fundamentals. What are fundamentals in the global listed property in the subsectors? What are they looking like? Are they still actually in a good state, or are we starting to see some cracks in certain subsectors?
On the whole, I would say that fundamentals are relatively stable within the listed real estate sector, and this is supported by a moderation in new supply that we see across multiple subsectors. I think this is as a result of an elevated financing environment as well as high construction costs, which have generally resulted in compressing spreads between development yields and cost of capital, which is actually a positive for existing landlords in terms of really bolstering the pricing power that they currently have. And therefore, we have seen some opportunities across markets and subsectors where this is the case in terms of favorable demand-supply dynamics, and the opportunity for REITs with strong balance sheets to still access debt capital under favorable terms, and therefore give them the opportunity to opportunistically enter into the transaction markets as favorable prospects emerge.
I want to touch on that, Zama. You gave me a nice segue. So if we turn to the transaction side of the coin and we look at deal activity in the market, what are you seeing? And especially let's focus on the US, relatively speaking to Europe. What are you seeing?
We are seeing quite a bit of strong momentum in the transaction market in Europe, as we've seen portfolio transactions as well as corporate transactions, particularly within the healthcare and student housing space. And I think that is really testament to the more supportive financing environment that the European Central Bank and the Bank of England have created, versus across the Atlantic in the US, transactions are moving. However, they are a bit more selective as a result of the tougher financing environment in the US. We've seen portfolio transactions happen within multiple subsectors, including apartments, healthcare, and offices to some extent in more appealing markets such as New York. However, there is a meaningful divergence between the US and the European transaction markets, which speaks to the difference in monetary policy.
So we've spoken so much about what has happened, right? So let's give our viewers a sense of how we see the world going forward. So let's focus on your and the team's outlook over the next few years. Like, where are you guys seeing opportunities? And where would you say you're slightly more cautious?
Despite the uncertainty that we have seen within the macro environment, I think the outlook for real estate remains constructive. This is supported by some of the factors that we've discussed in terms of a favorable demand-supply dynamic, as well as strong balance sheets that the REITs do boast, with a bit more favorable leverage ratios relative to historical levels, as well as a more staggered debt maturity profile, which supports earnings growth over time. I think that some of the sectors that we quite like at this point are supported by secular demand drivers that are not entirely dependent on economic cycles, which is quite positive. Some of that includes demographic drivers, as well as the proliferation of technologies and tech infrastructure growth. Some of the sectors that we like over the near term, supported by those dynamics, are single-family housing, where on the supply side, we've seen quite material underbuilding over the last decade in the US, which has led to an undersupply. But similarly, on the demand side, because of prohibitively high home ownership costs currently, we're seeing people renting for longer. Therefore, the demand side supports a growing above average market rent growth in that subsector. On the data center side, which is another subsector that we like at this moment, we're seeing that the rapid growth and adoption of AI technologies, cloud computing, as well as businesses and governments really looking to enhance their IT infrastructure, supports the demand side on data centers. And this is also supported by a supply or a new supply on the listed real estate side that is pre-leased for majority of the new supply that they expect, and therefore that helps with pricing power from that perspective. And then maybe on the cautious side, one of the sectors that we have remained underweight for quite some time is offices, which is essentially has not seen a dramatic improvement in utilization rates relative to pre-pandemic levels. However, in that subsector, we are seeing a continued flight to quality that supports a bifurcation between top class and subpar assets that we can really position ourselves well in terms of playing the different portfolios against one another. And then maybe just one last one on the more cautious side is senior housing, which on the demand side is actually experiencing quite healthy demographic drivers in the US's elderly population. However, we are starting to see bubbling concerns over labor availability, and this is exacerbated slightly by the immigration changes that are currently taking place in the US.
There's a lot to navigate, Summer, but on the whole, in my opinion, it sounds like most of the subsectors are in a good state, where most landlords are sitting with quite a bit of pricing power, because you're looking at quite a strong demand and supply being slightly muted or constrained. But in your view, and in closing, would you say that global listed property looks like a compelling asset class relative to others?
I think on the whole, we're looking at a relatively stable operating background for listed real estate, so we remain constructive on the sector. I think that some of the points that we've brought up in terms of favorable supply-demand dynamics across multiple subsectors, strong balance sheets, as well as moderating new supply within the financing environment that we find ourselves in, the strong earnings growth that is supported by long-term leases across multiple subsectors really offers a compelling earnings growth profile within the sector. We currently see a forward FAD yield, an estimated forward FAD yield of about 5.1% and a 4-year annual compound growth of just over 5% as well, which I think presents an attractive return profile for a lot of investors who are looking for income stability and growth.
That's close to double digits, right? Close. Summer, thank you for your time and sharing your valuable insights with us as always. Viewers, thank you for tuning in. If you'd like to learn more about our Q2 Global Dashboard, please reach out as per the link below, or alternatively, please reach out to me. Thank you for your time and goodbye.